Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
I have to apologize for the coughing. I've been talking the whole morning. I can't just stop it. In this week workshop, we're going to have a look at several issues related to the report writing. If you have a look at the last page of your assignment guideline, it's a marking criteria for assignment 2. That's 30% of the overall course grade. And with that 30% of the overall course grade, you have 20% from the multiple or asset-based evaluation, 30% still related to your DCF valuation model, and the largest weight is actually on the research notes. So it's the written form of communication of your valuation to your readers. In the past several weeks, we have been dealing with the way that you might improve your enterprise DCF valuation model, and also the tools that's available for you to run a multiple or asset-based evaluation. So today we're going to focus on the research report writing. Here you will find the requirement of the elements should be included in the written form of report. And in this lecture, I'm going to talk about how you might achieve a good grade in the research report writing. And the purpose I put a 40% research note for the second assignment is trying to give you the exercise, the opportunity to train yourself from writing as a student to writing closer to a professional analyst in the industry. So still, I want you to recall what you have been writing in other courses, the assignments. So there will be page requirements, will be words requirements, and there will be like format or the kind of analysis or tasks in the past assignments. But in this course, we're doing something different from your past assignments written by students, and the readers will be your lecturers, your peers of the same class. What we are doing here, that's research notes. We're trying to write something that's similar to the research analyst in the industry, and your target reader would not be lecturer or your classmates or tutors. Your target reader will be professional institutional investors like equity managers in the market. So they have rich resources and they have the ability to understand the valuation framework, the valuation principles, and they pay thousands of dollars to read your report as an equity analyst, to try to learn something that they don't know, or they may not have the complete picture. For instance, they're going to use your research report in security selection, in the security selection process to make investment decisions or asset allocation, or even try to understand the general performance of particular company, particular industry within Australian equity market. Or maybe that portfolio manager is from other countries. They are interested in investing in some Australian firms. They want to have a look at this research report on Woolies, this one of the largest companies on the stock market. They want to find out the company's valuation and the key drivers. So your target reader will be professional investors. They want to read something informative, and they want to read something punchy and concise. They don't really care if the report is 2 pages, 3 pages, or 4 pages, or 10 pages. There's I don't require you to have like a 10-page or 20-page research report. If it's concise, punchy, and you are very good at delivering the analysis of the valuation of the company, it can be done in just 2 or 3 pages, even including the appendix. So what you try to push the whole group to achieve is something to deliver information and analysis instead of submitting a report of a few pages of paragraph or irrelevant paragraphs. The words count, the page count don't really matter in the final grade of this research note. Actually, as a professional investor for the funds managers, they want something short. They don't like reading long sentences, complicated, structured sentences. They want to read something short, concise, and informative. So next, let's have a look at a sample analyst research report. This is from JP Morgan on JB Hi-Fi. It's a retail company, so it's sort of related to Woolworths. So this is not an initial covering of the company. It's actually an update of the valuation of the company based on some recent developments within the company. They have new CFO, that's the change at the top executives. And also the company has provided revised earnings guidance. So the analyst composed this research report based on these mainly 2 pieces of new information. The way that if you go through the way they structure the report, they will very straightforward, because the readers, like the portfolio managers, they don't need you to have a paragraph to talk about the business of the company or the industry size of the company. They are known to the portfolio managers. I don't want to read this from your research reports that I pay thousands of dollars every year. And it's very straightforward. In the top first paragraph, we have some top executive change, and we have a new updated earnings guidance from the company. That's the highlights of this valuation report. So these 2 pieces new information will be incorporated into the valuation or valuation update by the analyst. So it's straightforward. The story, that's the start of the story. And here we're going to incorporate this new information into our valuation. And here you have a few key points. The relation of the new information, that's NPAT, normalized profit after tax guidance. That's the guidance from the company, reaffirmed, but sales growth guidance lowered. So the company has issued earnings update saying that, okay, we have a similar earnings update from previous update or guidance to the market, but we do expect a slower sales growth in the next few quarters, in the next several period until the end of the financial year. That's the highlight of the new information. And that's the short paragraph, if you read this very short paragraph. The first sentence, that's the new update, the update from the management of the company, and following the update, we have adjusted normalized NPAT by amount, respectively. That's the impact from the new information on their valuation. That's a very good summary of the new information and the impact on valuation. That's the first page. It's not compulsory for you to organize your research note in this format, like a professional analyst research report, but you do need to have something like this. what's the new information or the start of your story about the company's valuation, and give a very concise, punchy summary of how this will drive the value of the company. So you have options to tell your story of the company's valuation in the format like this. New guidance, new development. Now it's the first quarter has ended, and have a look at the company's announcement. Do they have like earnings revision or any updates of their trading? You can start your story from here. Or if nothing new developing with Woolworths, you might just talk about the drivers of the company's value. So drivers here must be very specific, not something like general economic development. If you do believe in the in the medium term, at least the 3 years of time, it's a key driver of the value of the firm on top of the list of drivers. You got to be very clear why you believe this macroeconomic development is the key of the value for the company. So your belief and how this factor will be driving the value of the firm. So you have the options of how you may tell the story of the company's value, but make sure you are very specific. In this case, it's down to the dirt, down to the root of sales slowdown, and they have this corresponding adjustment of valuation. Over this report, it's got the analysis of about up here. Page 9, but with that, the body of the research report with 1 page of graphs, data, financial data, the actual estimate, and another page of charts and graphs. So basically the analysis only account for about 5 to 6 pages only. And at the end, you will have the disclaimers. You don't really have to have this in your research report, but if you don't want to make it look like a professional analyst research report, you can do this. So the last several 2 pages will be the disclaimer, and that's the, you might see this as like an introduction of the, maybe sometimes they include the development of the industry or the general equity market conditions. So all of these are not compulsory, but you do need to have something before page 8, 1 to 7, something that's really tell the story of the value of the company. And I do not have a formula or prescription of the sections that you have to include in your analysis. You have much freedom to be creative and to structure the report you want in the way that you want. In the workshop notes and also in the assignment guidelines, I do provide like a guide in terms of structuring your research report. It's only a guide. It doesn't mean that you have to write your research report in this order or in this way, or you are not required to include all of the sections in the list here. So it provides you a guidance. If you have no concepts, no ideas where you should start writing your report, you may have a look at, okay, this is what you may include in the research report. It's only one way of presenting your research analysis, so it's not a requirement. And also on w10, I provide you some resources on research report writing from CFA institution. And these resources were provided by CFEI for the students who participate in the CFA Research Challenge. So they are relevant resources to help students to start in terms of research analysis writing. You may have a look, but it doesn't mean that you have to include every single section in your report as what shows in the CFA recommendations. So basically, I give you the freedom to tell your own story of the company. You don't get penalty if it doesn't look like this one. If it doesn't look like a formal business report with executive summary or table of contents, you don't get penalty from this format. But I don't want you to have a concise, relevant analysis narrative. And I don't want to read anything that will show up in here. Some bad examples from past students' assignments. So I'll talk about this, the problem of this analysis. It's not necessary for you to have a 20-page report with a table of contents, executive summary, chapter 1 or section 1, 2, 3, or subsections. For a research note, it's not really a report. I want something short and brief. I don't want to spend my time flipping through a 20-page report. So here next, I'm going to talk about a few examples that the possible errors or style of writing you want to avoid in writing up this research note as a research analyst. The first example is based on an assignment in 2016. In 2016, I asked students to value a waste management company, Trans-Pacific Industry. It's a waste management. It got two major business segments. The first segment services the manufacturing companies, mining industries. They help them to clean up the waste, help them with the waste in construction process as well. So that's the general revenue from cleaning up the industrial waste or mining waste. The mining sector was one of the key drivers of the revenue in this segment. They have another segment, is called Clean Away. You will see Clean Away sector. You probably have seen these their trucks of Clean Away on street as well. So they provide curbside rubbish collection service. So the general revenue from the suburban councils, they probably will have agreement with, for instance, Balconen Council to collect the rubbish of all of the suburbs within this council for at this rate for a few years of time. So it's less risky, but probably lower margin. They have these two major business units. That's one of the analysis, part of the analysis from a student assignment. So obviously they generate a graph to show the revenue growth for the next several years. I want you to really read the paragraph over here. It's not big enough. Okay. Actually, that's the first page of their research report. So before that, it was just a short paragraph of the business, of the industry, and share price, and things like the market data you often read from a research analyst. So the opening of the research analysis, we predict revenue to grow at a rate of around 3% per annum over the next 5 years. No problem at all. But as equity portfolio manager, I try to understand the value of the firm, especially in the next several years, medium term, for instance, 3 years, to make an investment decision I want to know, okay, you forecast a revenue growth of 3% per annum. The industrial sector has been adversely affected by the mining sector decline in recent years. There's no problem with that at all, and you do observe the revenue decline after the global financial crisis that coincides with the weakened demand of Australian resources, and you will see that's because that's the dominant segment of the company. It does the overall revenue does coincide with the overall trend of the resources of the general economy. But there's something wrong with this. The second half of the sentence. It is expected to have low revenue growth in response. What do you mean by low revenue growth in response? If you look at the historical data, that's by financial year 2016, there was a rebound of revenue. In 2015 and 16, but in your research, you said it is expected to have low revenue growth in response to the decline of mining resource demand in the market. Is this consistent what you have observed over here? And you do forecast this scale is like 0-20%, like close to 3 or 5% revenue growth in the next more than 5 years, flat. So that's no problem. That to lay out, okay, what happened in the past several years, that the company was affected by the mining cycle, and there's a low revenue growth in the sector. When we say low revenue growth, how low is the low revenue growth for the company and for the industry? You got to define this low revenue growth in your analysis. Otherwise, it's not concise. It doesn't deliver information to your reader. And at a constant rate of 5%, in line with growth in the waste management sector. So you are telling quite different aspects of the company's revenue, the demand of resource, the cycle in the resource industry, and also the waste management sector. That's a very large sector. So the waste management sector includes the waste management of the curbside rubbish collection, recycling, the waste management related to healthcare services providers, the public hospitals, and other segments of the industry, and also the mining industry or construction industry as well. So you are telling a lot of things, but not concise. That 3%, you were talking about the cycle of the mining sector, but then you jump to the growth in the waste management sector. Why? So if you're going to forecast, if your valuation is really largely relying on the revenue from the mining resource sector, focus on that segment. Arbitrarily, without any consideration, just say in line with the growth in the waste management sector, is not something that will deliver any information or valuable inputs for the portfolio managers to make investment decisions at all. So this is quite confusing for me as an equity portfolio manager. If I'm interested in the waste management sector, I suppose it's a sector that still there's not substantial capex, and I do want to find out the growth potential of the company. So you have, based on this analysis, you have killed off all of probably the most promising growth segments of the company or industry. Just this is a biased or quite confusing analysis of the drivers of the company and the industry as well. The next paragraph, EBITDA and NOPAT margin. The group was on the right track that, okay, we identified revenue and margin as the driver of value. That's true, but the analysis is really not punchy or to that point. So that's TPI, Trans-Pacific Industries. Profit margin have fallen in recent times. Still, the data, historical data started from 2007. In recent times, the margin, that's the blue one, that's the EBITDA margin, dropped from 20 to 23% to about 15%. That's about a 40% drop. So that's a big drop in recent time. Still, and the rebound of the margin revenue in 15 and 16 have been ignored. What happened over 10 years ago? They are relevant. That's true. That's the financial crisis. All of the companies were in some way affected adversely by this global financial crisis. But they are in different state of economic development now in 2015 and 16, and they failed to discuss any of the latest development of the company's revenue and margin at all. Our analysis suggests the adjusted margin will be approximately 10%. That's the green line. Adjusted EBITDA margin. That's the output from your KGW model. Adjusted EBITDA margin. We do not think these margins are likely to rise in the medium term as the firm restructures to combat the ailing industry sector. It's all right to, this sentence is actually gives very much valuable analyst judgment in here that we believe. Actually, we don't really say think. We, as an analyst, we try to sell our beliefs, sell our opinions. We don't say think. That's a very weak word. We say we do not believe. That's a much stronger word to convince people to be on your side, to believe what you are trying to tell in your research report. So we do not believe these margins. They only talk about EBITDA margin only. What are these margins? Actually, they are talking about these three different measures of operation margin, but that's not a good way of writing in your report. Likely to rise in the medium term, and that's the reason firm restructures to combat the ailing industry sector. What's that restructuring? What's that restructuring? The company did have something in financial year 2016 about shifting much of its resources to the other segments. Not just they try to de-risk. They want to limit their exposure to the resource industry. So restructures in finance, especially in corporate valuation, when we say restructures, we mean the change of the business segments, selling or buying new segments, or we do something substantial. We shift the resources of the company from one segment to another. That's the implicit meaning of restructures. Or sometimes they have quite different dramatic changes of the corporate strategy. For example, they shift from a competition of pricing to competing in efficiency gains. These are restructures. That's not the case for TPI for that financial year 2016. So this may be understood in some context. My point is that it's good that you identify the changes of the company, but you got to be very concise and specific. What do you believe the changes of the margin are related to the specific actions or approaches taken by the company right now and will be in place for the next several medium term, 3 to 5 years? So overall, this group's assignment, the analysis was written in this way throughout the whole research note. They did have reasonable graphs, reasonable analysis. I could tell because I've been reviewing the assignment one. I reviewed the whole model, valuation model, and they do have something in the forecasting model and the Porter's analysis, ROIC analysis. So when I have this context, I do understand what they mean in here with the growth in the waste management sector or these margins or ailing industry sector. So I do understand. But for a reader, outside reader, who just want to know what's your view of the company's value and the drivers and how the drivers are related to the valuation, they're going to be confused. So this research report was rated in this category as 70%, up to 70%. So I can tell that you do understand the drivers and you're trying to analyze how these drivers are related to the valuation of the company and the outlook. And you do take a medium to long-term time frame, but it's not up to up there like close to 80%. Next paragraph is from another group. That still, I'll just show you how long that analysis will be. That's still the first page of the research notes. Before that, there was like still the company, they are trying to provide a valuation, the key drivers, very short paragraph. This group actually did really well to provide a summary. They talk about the business drivers of the company in a very short paragraph and quite well. But then after that, and on the first page, it's like no more than 10-page research report. I had this paragraph. Now I want you to read them, just take a few minutes to read it. Is it a collection of analysis of the company's value or analysis of the macroeconomic factors that are closely related to the company's valuation, revenue, margin, or spread between ROIC and WACC? No. It's a collection of facts that I know. So exchange rate, GFC, resource price, Australian economic growth, US Federal Reserve, the possibility of recession. It's a collection of facts. But if it's okay, you talk about the macroeconomic analysis, but you have to provide a discussion of how this is going to be related to the company's valuation. I pay you thousands of dollars every year. I don't want to read this. So when I review their research report, I didn't read it at all, anything. I just skip and scroll down to the next page. It doesn't tell me anything about the company's valuation. It's waste management company and really struggling with its margin, and this we see a decline and some possibility of growth in the industry. It's not related to the valuation at all, but it's very likely I'm still going to read research reports written by this class in this way. If you have a look at this research report, you're not going to find anything of this. Through the report, the first page is a summary of the key points of the drivers and how these drivers will be related to valuation, their update of the company's valuation. And very specifically, they discuss the sales guidance and the implication of the sales slowdown on valuation of the company and its prospect in the next 2 financial years. We want to see facts, outcome, and a discussion of the association between facts and outcome. Outcome means valuation. From here, you don't really see anything. There's a bundle of facts, and I don't really see how they are related to the valuation of the company or its competitive advantage in the industry, or it's not related to how the company is going to generate shareholder value. So I want you to try to avoid writing something they are irrelevant to the valuation, to the value drivers of the company, and any discussion in such a general nature. I don't want to read it because your target reader are not your mom and dad or any or like the first year finance students. You're not writing introduction article or report for them to understand the current development of Australian economy or world economy. No, you're writing the research report for portfolio managers who are going to try to understand your opinion of the company's valuation given the current development of the company, the industry, and the economy. The next paragraph, in 2016, I still required students to run scenario analysis, but sensitivity analysis was optional. This group, it's a different group again, and they did the sensitivity analysis, but it's something what they did was quite typical for finance students who have a model. Okay, how exciting, we have such a complicated, fancy model, let's play with it. And the more we play with it, the more value we can incorporate into our research report or the final valuation. But that's not the case. The sensitivity analysis output, the quality of this sensitivity analysis is based on the quality of your valuation model. So we have very good understanding so far that the KGW model is a mechanical spreadsheet. Although it's complicated, lots of things going on, it's a mechanical model spreadsheet that doesn't understand the risk of the company going forward. It doesn't understand any corporate strategies of the company, or it doesn't understand any competitive advantages of the company. It's just a technical tool and it's rigid. So any sensitivity analysis by simply changing some of the parameters doesn't produce any marginal benefits of doing so. So I would suggest you, firstly, identify the weakness of your valuation model, not the KGW model. Valuation model, that's the rounded story of how the value of the company is created, not really the numbers, the Excel spreadsheets. Identify the weakness of your valuation model and some risk factors of your valuation model and try to plug in different parameter estimate, try to change some key assumptions and see how the valuation might change or other ROIC-related performance measures might change. Are they within your expectation? If yes, and try to understand why. If not, that's a warning sign that you need to find out why this change is out of your expectation. So in this group analysis of sensitivity of their valuation model, they did, there are a lot of other sensitivity analysis involved, and they do have very complicated structure of running this sensitivity analysis. They spend a lot of time playing with the model. It's like a laundry list of all of the key inputs across several spreadsheets. They tested the sensitivity of the final valuation to a list of variables: margin, revenue growth, all of the inputs of the WACC parameters, and even CapEx. So it looks like a thorough exercise, but what you have gained from this exercise is very questionable. And if you read this, they did do a lot of play with the model, but they only included the change in EBITDA margin to show that they have done the sensitivity analysis. So that's what they have included in the research report. Key business drivers of TPI were analyzed to observe the sensitivity of the share price to potential changes in our forecast of key drivers: revenue growth rate, margin, CapEx, these financial variables. TPI is most sensitive to change in EBITDA margin, where a 2% change leads to 285% change in the share price. It's actually a flag that there might be something wrong with the valuation model. And they believe they mistakenly thought this is sensitivity of value to EBITDA margin. EBITDA margin also causes the largest change in ROIC of 18%, with only 2% increase in the margin. That's a valid judgment. So 2% increase of margin, that leads to 18% change of ROIC. It's still another flag. There must be something wrong with the valuation model. So the waste management industry is not something, it's not a new industry. It's supposed to be like a boring, mature company. Trans-Pacific has been there for many years. Before public listing, it was a private company, but the company, its business, have been there for like almost 2 decades of time. It's a mature company, and there's no exciting growth opportunities, and that huge change of ROIC is not really very likely for a company like this, operating at 8%, 10% adjusted EBITDA margin. So the group has done some play with the sensitivity analysis with their KGW model, but they failed to extract value from this exercise at all. And in the last sentence, that's a typical mistake by students as well. If this does not occur, what's this? In the analysis report, if you go to read the JB Hi-Fi report, they rarely use this kind of vague reference in their analysis at all. And the sensitivity analysis shows that even 1% decrease of the EBITDA margin can lead to a very negative valuation for TPI. Very negative valuation. What's a very negative valuation? If I'm the equity manager I'm reading this report. Okay. I can tell that there's something wrong with your valuation model, but it doesn't tell me how sensitive of the valuation to different assumptions of your business drivers at all. So if just solely based on this analysis, they won't get like even a pass grade for the sensitivity analysis at all. They have not achieved any purpose of the sensitivity analysis. And in terms of the writing style, I understand the difficulty of trying to push yourself to write as a student, write whatever you want, as long as it's within the page limit or word count. Sometimes you want to write something irrelevant so that you can reach the word or page requirement. That's not the case for this course. And you've got to write something informative and provide information for the reader. Like, you have to try to avoid the use of adjectives and adverbs. They tend to be not concise at all and will cause this confusion in understanding what's a negative valuation. It doesn't say anything about the company's valuation. Okay, so let's have a look at the professional analysis of the margin. If you read through this professional analyst report, you'll find they rarely use any adverbs or adjectives. They don't say good performance, bad performance, this kind of things, because they do not carry any meaning for the professional investors, for the portfolio managers at all. That's the analysis of the JB Hi-Fi EBIT margin following the recent development of the company, the earnings revision, the slower sales growth forecast by the company, and the for that margin, that's the main catalyst. So implication, that's the what happened to the company. Implication for EBIT margin. Following the detail on this trading update, so from the first page, the company has provided the trading update. We have updated our earnings as noted later in this note. So here, a analysis of the impact on margin, and from later pages, you have updates of its forecasted P&L and balance sheet as well. Yes?
I can see adjectives in there. The challenging environment. Is that an adjective? The label describes that
Challenging environment, and that's fine in this context. And you got to follow that. You got to discuss how this is going to affect the company's valuation from which dimension of your analysis.
Can I say, like you say, the company had a strong performance?
That's fine. If you say strong performance and follow that, you have your justification or elaboration of strong performance, how this strong performance is generated by what approach or strategies. You simply have this single sentence of the company has been having strong performance, and that's it. Then you got to discuss the something else. That's not a real coherent discussion. You got to, that strong performance is driven by the industry revenue growth, strong trend in there, and also the competitive advantage within the industry that they are able to maintain this margin. Yes.
What's wrong with the very negative? Didn't they justify that?
That very negative valuation?
Justify it. Right?
Okay, we can only observe that from when they got to change the EBITDA margin, and they observe the share price. that's the change, the scale of the change in the share price valuation of their model. There might be something wrong with the valuation model itself.
Oh, so you're just saying that's wrong, that what you highlighted in yellow is wrong?
That's a warning sign that there must be something wrong with their valuation model. But they might have observed this drop of 285% drop in the share price of their valuation, but simply saying